Okay, so I'm going to review the price action around NASDAQ and gold today. I'm going to point to some of the things I was looking at, why I wanted to see them, the trades I took, and I'm going to introduce a little bit more on the idea of how I use 4 a.m. opening price to find a trade each day. And just for good measure, I've thrown on 10 a.m. opening as well, because I used it recently in a trade. So let's go NASDAQ first, because it's less things to talk about. I'll go full screen. So first things first, what you're looking at right here is how I would view my charts if I removed everything else that's technical in my arsenal. If I told myself I'm going to trade time or time to deliver only, these would be the most important, or let me not say most important, these would be the starting points for me to look at. And to show you how they all play together, the 4 a.m. opening price would be the price level I'd be watching after 8 o'clock to find a setup. Depending on where we open at 8 o'clock, it may not always be right here. But if it is right here, I'm looking for this level, that 4 a.m. open, to act as either support or resistance within the narrative. Now, for me, NASDAQ was being drawn to 11,600. And if you want to get a better understanding as to where that's coming from, just go to the daily chart. Look at last week's delivery. It was trading higher in an overwhelmingly consolidating daily structure. So retracement seeking balances and the daily structure equilibrium, 11.6 was the low of a daily fair value gap. I'll just show you that real quickly. I think if I do that. Right here, this one. So this was my draw. It's not exactly 11.6, but 11.6 is a nice round number that should be good enough. So that's why I had 11.6 tagged. So I was long on Friday, all the way down here, and I think we talked about this on Friday when I was saying I want to see the OLR before the setup, price swept lower, and then I went long, and since then I've been waiting for 11,600, which means I'm going into the market today and my drawn liquidity is 11,600, which makes me bullish. If at 8 o'clock we're below 11,600, then that's even perfect, because that tells me that my setup is going to form somewhere within either the opening price at 8 to 11,600 or the opening price at 4 after 8 a.m. 11,600. So from a bare bones perspective, if I saw that we opened at 8, all right, so watch this closely. At 8 o'clock, we're basically opening at the same place. This is telling me that the sentiment I want is being built around here. So I'm looking for one of two things after 8 o'clock because I'm already bullish. So my bias has been determined. My drawn liquidity has been determined. The only thing I want to see now is my setup and confirmation of a market structure shift. Well, confirmation of a change in the state of delivery. So at 8, it's already at 4. So I'm not expecting any deep runs lower. I'm just looking for a change in the state of delivery. To put that simply, I want to see down candles highs being traded through. Once I get my down candles highs being traded through, I want to make sure that the down candles lows are staying in the market, because then bullish order flow would be nice. I don't think I took this long. I think the long I took was maybe this or this. I don't remember. I took it from my phone, so the structure looks a little bit different. But it wasn't here because I was trading gold at this time. So if I was trading mechanically, my setup would be this. And now I've explained why. For added confluence, if I'm looking for an entry to be formed somewhere between 8 a.m. open and 4 a.m. open in a bullish market, and they both are this close to each other in terms of the price level, it means that I don't need to wait for a deeper run. I can trust what's happening right here and manage the risk. So in this case, we have big down candle at 8. Then we trade above it right here. I'm willing to buy the retracement. Put my stop here, right? I'm not going to poke my stop all the way up here just because I want to have a small stop. The point of a stop is to protect you when you're wrong, as well as second one just jumped out of my head, but mainly to protect you if you're wrong. So the trade idea would be that. That's a trade idea. I might not get that trade because I might not see when the entry form. You know, we're human, something might happen. Maybe I'll get this one and then my stop is the same place. Just means that something about the execution will be a little bit off, but the idea remains the same. The drawn liquidity is the same. The order flow is the same. What I want from my entry confirmation has already been given. So here, entry. Anywhere else, here, entry. Now, the thing about entering all the way up here is that you have to think about where do you consider the trade idea invalidated? Yeah, so that was the second point I was trying to remember. The stop loss is to protect you when you're wrong, as well as show you where to watch for the trade idea being invalidated. Because you could take a trade with the idea, but the trade, like your entry, is wrong, but the trade idea is still valid. So as long as we don't trade below this low, I'm willing to buy retracements at logical price levels. So this would have been a buy I would also take. As a matter of fact, this, I remember now, I took this trade. This got 50 points here, 4 entries, partials, traded down into this imbalance here, completing the macro, traded higher. When we traded above here, I closed the full position and I walked away because that was enough. Right? You don't want to be overly greedy. But yeah, close the trade here. So main takeaways from this setup is 4 a.m. open identified, waiting for 8 o'clock to create a setup either at that opening price or 4 a.m. opening price, and that should be enough. There are elements that could get you more precise entries, but you don't need that. You just need to be able to frame what the idea should look like, look for confirmations, and execute. If you search for precision before you understand the narrative, and you'll get a beautiful sell entry on this wick, and then it screams higher. But if you understand the narrative, you get the entry all the way up here, and then you get this much of the move, and that's enough. You could get half of this and you should be fine. So the idea is identifying the drawn liquidity, the order flow, what time your setup should form, what price level the setup is likely to form. We don't move the markets, so we play the things that are in our favor. And that was beautiful. The next one is gold. Gold is very nice as well. So let's take a moment to look at this using the same things I just talked about. DXY is bearish in my opinion, so I'm looking for gold longs. Scoot over a little bit. Here's 4 a.m. open. Even if I have this identified before 8 o'clock, I need something else to be willing to take a trade lower. I got up earlier than usual today. I saw price trading down here. I saw the delivery here. It was starting to get very efficient, which means anything happening here is not manipulation. Meaning manipulation generally comes in the form of a very fast move that's inefficient, so and it gets rebalanced later and then we push away. This is slow and efficient. I'm thinking once we trade above here, that's going to create a change in the state of delivery. So I entered down here with the understanding that, well, I think I entered here. I entered at 7 lies. At 701, I went short. 701 is right inside somewhere here. which means I would be in at least 24 minutes before this time, which would have been somewhere about 30 something. So somewhere inside here, I went long. Exited here, went short, got like 20 points, stopped me at break even. But because the order flow is bullish, I wasn't interested in going for another short. So instead I waited for it to trade low and then played long. So let's look at the difference between this setup and the Nas setup. At 8 a.m., gold's opening price is a little bit lower than Nasdaq was, and it's a little bit lower than the 4 a.m. open price. So I'm thinking, if this is going to be bullish, right, I'm either going to see one of two things: a run on sell side or a discount already being traded to. We already had lots of sell side runs right here, efficiently delivered price action, then a displacement. This displacement, to me, is sponsorship. We had a down candle, then a large expansion that traded above an old high, or this old high. Either one, they're all old highs. So this, to me, if that's sponsorship, the potential of that being an order block is great. So I want to identify that area, and I want to identify that. So now I have a price that's below 4 a.m. open when I don't need to see another run on stops. So I just need to see a discount array. I found my discount array. Price comes down. I buy right here with the drawn liquidity at 1928, because 1928 is a daily volume imbalance. So we buy here. And I think we're talking about this M5 order block being validated. I had it marked on the M1 chart, so I entered on the M1, and then that was the run. So by this alone, if you backtest, if you feel so inclined, if you look at 4 a.m. open, extend that price out in time, and you mark 8 a.m. open because I start trading here, look at the correlation between what happens inside that range. But don't just look at it from a setup standpoint. Look at it in terms of at 8 o'clock, if you had no delivery. So let's play this for a second. Let's do this. If you couldn't see anything before 8 o'clock and you opened your chart and you're trying to firm a setup, what would you be looking for? What's the order flow and where's the drawn liquidity? If I'm bearish, I'm thinking this low. If I'm bullish, I'm thinking this high. So if that's the range that we have, I'm looking at where did we open inside this range and where can I find the next spot to buy? If I want to buy discount, it's going to be below here. If I want to sell premium, it's going to be here. If the drawn liquidity is higher and we're in discount runs and then higher, it's fine. Or sell side liquidity run and higher is fine. But I guess it's going to come down to the things that you cherish, because most persons don't look at things like this. Most persons just identify a daily high and a daily low, and they know that order flow is bullish, so they want to buy until the price gets to the high without factoring any of the delivery here. And that's how you fail. You fail because you're forcing the market to do what you see that it's doing. So let's say that everybody could see that this is the drawn liquidity, just a random price. And you could see the range right here, that low to that high. Most persons just want to identify and then buy without looking at what's happening. How do you frame if this is going to run that low before your long setup? How do you frame if it's just going to drop and then go higher? 4 a.m. and 8 a.m. does a really good job of identifying that level. But I'll leave that for you to backtest and find out. So automatically, if you're bullish at 8 a.m., I start looking back right here because I believe that there are reference points in the market where the algo looks back to identify what's the range that we're trading in, and then the swings get framed around that. That's what I think. That's a theory I'm working with. Until it's proven false, I will continue trading like that. So drawn liquidity because that's above highs, so liquidity pool. And that's what I want to see. So if we take all of this off now, I've already identified the direction I want to trade. The only thing I have to focus on down here is what gives me confirmation to enter now. Market structure shift or a change in the state of delivery. So your market structure shift could be trading above an old high, creating a dealing range and then retracing. Or it could be a stop onto the downside. But whatever it is, that's the only thing you start looking for here. If you open your charts and you start looking for the drawn liquidity, the order flow, and everything at that point, then you're already setting yourself up for extra work. And trading is already as hard as it is. I don't need extra work when I start. I want to be clear. So for me, the best way to do that is to have what I call a day zero check. At the end of each trading week, Saturday mornings, I do my review. I review the week, I review the delivery, I journal, and that's it. On Sundays, when the market opens, I do my day zero check. That means I go back to a daily chart. I look at what was the order flow last week and what was the drawn liquidity last week. Did we get to the drawn liquidity? If it got to the drawn liquidity, then I'm thinking, where's the next drawn liquidity? If it didn't get to the drawn liquidity, then it's about where are we in relation to the drawn liquidity and can I find a logical continuation trade? That's it. Once I know that price level, I don't need to go back to a daily chart. In the week, when I'm trading, I'll likely not go back to a daily chart because I identify where that price is. So on a lower time frame, like for Nas, it's 11.6. All I'm doing is looking for a setup that trades towards 11.6. So that's less work already, but most persons just want to do everything at once. My opinion, fix that. Should be fine. Can you explain and show order flow, how to identify if the order flow is bullish or bearish? When the order flow changes, I can try. So a change in order flow, in my opinion, is the same as a reversal. Reversals, based on ICT month one, are paired with liquidity pools. If I think gold is going to reverse here and go lower, because all of this is bullish, I would have to find a pool of buy-side liquidity that we just traded into. Then I would have to see a market structure shift. If I don't see a market structure shift, I want to see some evidence that the state of delivery is no longer on buy side. How do I frame that on a daily chart? Up candles low. If we're bullish and I'm seeing daily up candles lows being violated, then I get interested in short setups. If I don't see that, why am I trying to sell against all of this? So pretty simple, really. Yeah, it's gonna be on YouTube. It's gonna be on YouTube. So that's it. So for gold, this order flow is clearly going higher. This is a run on buy side. For NASDAQ, if we go to the daily chart, this is clearly a consolidation. So if I take the lines off and I will share what I've been, I think I mentioned it last week on the call. That is the consolidation range. If that's the consolidation range, it means all of last week, the most important price level is this. That's the most important price level all of last week. So if you can do this on your own, start at Monday to Friday and outline the entire delivery on a lower time frame, maybe an hourly, 5 minute, 10, 15, and watch how did we trade towards this each day. You'll see elements of my model. In particular, the accumulation, the failure swing, because it failed to get to the objective, the opposing liquidity run, then the entry formed. Wednesday and Thursday, I didn't trade. Friday, I got the setup. So, patience pays. I felt like we were being drawn to here. And we were. Can you explain BPR? Still don't understand it. Is the ATM EST look back for equity as well? There are a couple of things about the equities markets that differ, in my opinion, as it relates to timing. I wouldn't say start your look back exactly at 8 a.m., but there is a look back period. Start after 8 p.m. It's after 8 p.m. And then you should be fine. BPR just means a balanced price range. It means that we had price being delivered to both sides of the market. It's the same, or it should be the same as an efficiently traded range, except an efficiently traded range does not always have an expansion away from it. I think a BPR requires that expansion away. So let's say high, low, buy side, sell side, this place. I'm thinking BPR, don't come back below here. Or if it does trade below here, it should be rejected like this. So simple way to look at BPR. What did you mean by the market is a phone number 915? All right, that number that you posted is incorrect. It's 915-4115. Can't hear me? Not sure why. Nothing's changed on my end. Unless the internet company cut me out. Yeah. So that means efficient price means we're delivered to buy side and sell side. So before I continue, I need you guys to accept that everything I'm saying here is not, one, financial advice, of course, and two, I did not create or participate in any of the algos that run the market, right? That's not me, that's ICT. But from my back testing and studying, I've seen a lot of elements that repeat statistical edge, statistical advantage. Because of that, I place a great amount of faith and sometimes risk on them because they keep repeating. Okay. For BPRs, there are, for me, bullish and bearish BPRs based on the price action and based on the market structure. If I'm bullish and I want to see price trade down into a BPR, I rather the range of 1 wick being filled by a body, up candle body to be precise. When that happens, I like the idea of a BPR. If you blend that with any kind of or any other logic that's bullish, you should have very clear order flow. But don't take my word for it, check. And then vice versa if you're bearish. If I have a wick and a down candle body passing through the same range, I love those for BPRs. How can I study your model? YouTube, there's an entire playlist I created called the OB model playlist, filled with everything that I would share with you if we're, talking on a daily basis and I'm outlining stuff. Those are the things that I would use. So yeah. So one single wick, down candle body, this is likely to reject price. And it did. One single body, up candle, and a wick. If we're coming down, that's likely to reject price. And it did. So if we close below something like this, I can't be bullish, knowing that a balanced price range has been broken. Likewise, if we close above here, I can't be bearish. So if you're looking for invalidation points, those are good examples to use. You back test it Don't take my word for it. Like I said, it's a theory. I may not be right. You may find a better way to view it. So, one rule that made my life easier as it relates to trading is stop going to a lower time frame to try and determine order flow. Just stop. Literally, just stop. Doesn't matter how good you are, doesn't matter how much things you've seen, doesn't matter what anybody, even me, say. Use a daily chart to determine your order flow. Use a daily chart to find your drawn liquidity. When you go to a lower time frame, you shouldn't be trying to determine the order flow and all that. You can determine the state of delivery on a lower time frame. Because if this is bearish and price is trading higher and everything here is bearish, the state of delivery is bullish, or the state of delivery is on buy side. It doesn't mean that the order flow is bullish. Order flow is bearish and it's just a retracement. The condition in the market is a retracement. So then identify the higher time frame imbalances that are in line with the order flow. And wait, I'm a day trader. I try to trade every single day. Wednesday and Thursday last week, I didn't get any trades because I was unwilling to accept the risks that were present with the setups. So I did see setups. I didn't like the risk on them. That's maturity. Not every setup is going to be worth the risk. Like you won't catch me trading GB, some pairs. You won't catch me trading some pairs because even though I can see the delivery, they wick a lot, and I'm not going to give myself more work for less money on pairs that don't pay me well. Nasdaq and gold pays really well. So sharpen my edge and I play in that box. That's it. God's kid, thank you for hopping on. But yeah, stop. There's this thing that's passed around and it's going to offend a lot of persons. Probably, hopefully not. Your daily highs and daily lows, while they can house liquidity, it's not the panacea for what you look at. So let's say the market's bearish here and you automatically start look at a daily low. I'm going to go trade below a daily low. Why that daily low? You don't know. Price trades below the daily low. You don't know if you close your trade or not. You're overthinking. So identify the draw and remove that question. Remove the question of should I get out here or not. Just tell yourself when it gets there, I'm going to come out. If you feel like the order flow is with you, so let's say you sold here, you traded below this. If the narrative says that we're bearish and you believe that it's likely to trade here, take the risk out of the trade. When you take the risk out of a trade and you leave partials running, it becomes less of are you willing to hold, but more of are you disciplined enough to hold? Once the risk is on, you can't lose. Trading, the core tenets of trading is not to make money, it's to preserve your capital. My screen just flashed, which means that you may or may not have heard some of what I just said, but I was saying that protect your money. I try to trade every day. Should everybody trade every day? No. But with my model, I likely find setups every single day. I analyze 3 pairs daily. I take the ones with the highest setups. Some days you'll hear me talk about gold. Some days you'll hear me talk about Nas. Some days you'll hear me talk about AU a lot. Some days that you'll just hear me be quiet. That's simply because while my model is present, the probability is not as great as I'd like. And that's just something you have to accept. Protect the capital, come back another day. Look at Wednesday and Thursday, really large days. I got none of that. I got Friday. How can I be mad at myself for missing these moves? Negative self-talk. Don't do that. Next thing you guys should fix after you're good with, I'm assuming that this is a common problem, right? Not pointing any fingers. Once your order flow and your drawn liquidity is clear, the next thing that should be clear is your process. The process must be clear. What do you do every single day when you get up? You wake up, I don't know, you get yourself ready, just jump on the charts and start trading. Jump on a chart and you start looking for where's the market moving to, and you try to get a trade in that direction. There's no structure to that. If there's no structure to your trading, how do you identify when your wins are based on you following your model, or when your wins are based on just you being lucky? How do you do that if there's no structure? How do you tell yourself that, I won this trade, but man, it was not the best setup, but I'm glad I won, and you moved on. Not planning to repeat the same mistake because it could be that trade was crap and I still put the full risk on and I lost. So you make your process rigid. Make some things about your trading non-negotiable. At least 3 things should be non-negotiable that you could use to gauge your performance. And if you should ever go against those, have a rule for that. I don't trade before 8 o'clock. If I trade before 8 o'clock, I'm not using the normal risk I'd use as I trade after 8 o'clock. If I'm trading before 8 o'clock, which is so rare, today is one of those extremely rare days. I have rules that tell me what pairs are likely to move before 8 o'clock, what pairs are worth my time. If I can find 2 good setups before 8 o'clock, let's just say I'm looking before 8 o'clock. I don't, but let's just say I am looking before 8 o'clock. And I see a AU 30 pip sell and a gold 30 pip sell. I have to decide which of these is higher probability. I have to do more work. If both of them look like crap, then they're just crap and you walk away. You wait until 8 o'clock. But the thing is, most persons are not that rigid to say to themselves, if I blow this account or if I take a loss, nobody's going to say, why did you blow the account? Nobody holds you accountable. Nobody says, you started the week with a bullish bias. Why are you selling and taking losses? Nobody says that to you, especially if you're a full-time trader. So you have to say that to yourself. Order flow is bullish, but I see this nice setup. I usually trade 1 lot because I'm going against the order flow. Even though it's a higher probability trade, I'm going to go half a lot. And I'm going to be comfortable knowing that if I win this trade, it's all good. If I lose this trade, it's all good. Especially if I lose this trade, it's all good because I went in with less risk, knowing that the probability was against me. Simple things like that. Ending your day early and walk away and find something to do. It shows you that trading is great, but you can be a better trader if you just control your actions around trading. Then if time is one thing that's rigid, the next thing that should be rigid is how do you frame your targets? You can't be going for 10 pips today, 20 pips tomorrow, 100 pips tomorrow, the day after that. There's a consistency. Your approach isn't consistent, but you want to be a consistent trader. How does that make sense? You have to have that. If trading was your job, your rules would be created for you. Everybody who had a job had a schedule. What time you take lunch, what time you do this, what time you do that. And we all work great. You don't want to get fired. But with trading, we don't set our own schedule. You don't have a calendar. You don't treat it like a business. Treat it like a video game. And I'm not saying everybody's different, right? Everybody's different. I'm not trying to tell you how to run your life, but advice from a humble trader. Make some things about your trading rigid. The time should be rigid. You don't trade every single day. Well, you don't trade every single time of the day. Try to put the probabilities in your favor and then try to understand the time window that you trade. I understand New York very, very well. Asian, completely rubbish, in my opinion. I don't think Asian session should be traded. I think Asian session and London Open has one goal and one goal open only. That goal is to engineer liquidity. So 95% of the times when you're trading Asian and London, or you're trading New York and you're running for Asian high or London high, you're not actually trading in reality for that high or low. You're going for the liquidity that was created in that period. That's why those trades win. But if you don't understand that, then you win a trade and you don't understand when to target Asian high and when to not target Asian high. You don't understand when to do stuff like this. So this call is coming to an end now. So let me change your perspective for a second. You don't understand when to do this. And this is what I see. You see every aspect of the chart. I don't see everything on the chart. I only see this part. But it's been fun. Hopefully that helps to improve somebody's trading. Look forward to talking to you guys in the chat and enjoy the rest of your day. Thank you guys for coming out.
Cheers, mate.